All right, let's dive into the latest numbers from one of America's biggest grocers, Kroger. Because let me tell you, when you first look at their latest earnings report, it tells a wild, almost unbelievable story. Right out of the gate, you see this number. That is their official operating profit for the third quarter. And yeah, you're seeing that right. That's a loss of over $1.5 billion in just 3 months. I mean, wow. For a company that sells groceries to millions of us every single day, that is a staggering figure. So that leads us to the big mystery we're going to unpack today. What on earth happened here? How does a company this huge post a loss that big? Well, stick with me because the answer is probably not what you're thinking. To solve this, we've got to start by digging into where this headline number even comes from. But as we do, things actually get even more confusing. Okay, but get this. At the same time they're reporting that massive loss, you have this quote from Kroger's own chairman and CEO. He says they delivered strong results. Wait, what? How can you have strong results and a $1.5 billion loss? It just doesn't add up. And this, right here, is where the real story begins. You see, the key to this whole puzzle lies in a single, massive, one-time event that completely twisted the official numbers. So let's peel back that layer and see what's really going on. Here's the culprit. In their official books, Kroger took a massive one-time charge of $2.6 billion. Now, this was something called an impairment charge, and it's related to their automated fulfillment network. It's a huge accounting write-down, but, and this is the important part, it's not a reflection of how their day-to-day business of selling milk and bread is actually doing. And this brings us to a really crucial idea: GAAP versus adjusted profit. The easiest way to think about it is like your personal budget. GAAP profit is your total spending for the month, including that one time you had to drop $2,000 on a new car transmission. It's a real expense, it's painful, but it doesn't reflect your normal monthly spending, right? Well, adjusted profit is like your budget without that surprise car repair. It shows the real health of your day-to-day finances. So when you look at the two numbers side by side, the whole mystery just dissolves. On the left, you've got that official GAAP number, totally dragged down by that huge one-time charge. But on the right, you have their adjusted profit. This number removes that charge to show you what's really happening. And what do you see? A profit of over $1 billion. That's the real story. Okay, now that we've solved the billion-dollar mystery, let's look at what the CEO was actually talking about. What were those strong results? For starters, their e-commerce business is absolutely on fire. It grew an incredible 17% over last year. That is a huge priority for them, and that's a fantastic number. And it's not just online either. Sales at their established stores, what the industry calls identical sales, grew by 2.6%. This shows that their core physical grocery business is growing steadily too. And when all that performance trickles down to the bottom line, their adjusted earnings per share actually grew by 7%, hitting $1.05. So not only is the business profitable, its profitability is actually growing. And this strength is coming from all over. Their pharmacy business is growing strong. Their popular private label products, what they call R brands, are boosting profit margins, and they're getting better and better at controlling costs in their supply chain. It's a really solid picture. This strong performance isn't just a happy accident. It's all part of a much bigger strategy. So let's zoom out and see how this all fits into their long-term plan, which they call their value creation model. It all starts right here, with the simple, tangible things that people buy every single day. Their massive grocery, pharmacy, and fuel businesses, that's the foundation for everything else they do. And that foundation powers a really clever growth engine. So step 1 is that strong retail business. That leads to step 2. All that business brings in millions of customers, which generates a total treasure trove of data. Then comes step 3. They use that data to fuel what they call alternative profits, like their retail media business, where brands pay to advertise to Kroger shoppers. And finally, step 4. All of that comes together to deliver a strong return for shareholders. And the scale we're talking about here is just immense. We're talking nearly 2,700 stores, data from 63 million households, and their private label and e-commerce businesses are multi-billion-dollar operations all on their own. This is the bedrock of their whole strategy. So, after a quarter with such strong underlying performance, how are they feeling about the future? Well, let's take a look at their updated guidance for the rest of the year. You can see right here that they actually grew more confident. They narrowed their sales forecast to a tighter, slightly higher range.
And crucially, look at this. They raised the bottom end of their earnings per share guidance. That's a really clear signal that they believe this positive momentum is going to continue.
And all of this brings us to the final big picture question. Kroger is clearly betting its future on technology, on automation, and on data. But at its heart, it's still a grocery store. So the question we're left with is this. As they push hard into the future, can they maintain that crucial human connection in the physical aisles that made them who they are today? That balance is going to be the key to their story going forward.